Hello and welcome to Explain the Charts. Today is November 9th, 2025, and we are taking a close look at the US dollar versus the Japanese yen, or USDJPY. This pair is showing extreme volatility as it's caught between two powerful and conflicting narratives, so today we'll unpack the news and then dive into the charts to see what they're telling us. First, let's discuss the fundamental picture. The market is currently grappling with major uncertainty from both the Bank of Japan and the U.S. Federal Reserve. In Japan, hopes for an imminent interest rate hike are fading. Recent data showed that household spending is cooling, which tempers expectations for the BOJ to tighten its policy, especially with a new prime minister who favors economic stimulus. A more dovish or less aggressive Bank of Japan is typically bearish for the yen, which in turn is bullish for the USD-JPY pair. On the other side of the equation, the US dollar is facing its own headwinds. A prolonged US government shutdown is causing economic concerns and, crucially, a blackout of official labor market data. However, private data from Challenger, Gray, and Christmas showed a huge surge in job cuts for October, fueling speculation that the Federal Reserve will be forced to cut interest rates in December. The CME FedWatch tool now shows a greater than 70% chance of a December rate cut, which is weighing heavily on the US dollar. So we have a classic standoff, a weakening yen due to a dovish BOJ and a weakening dollar due to a struggling US economy. This conflict is creating the sharp, range-bound price action we've been seeing recently. Another critical factor to keep in mind is the threat of intervention from Japanese authorities. Officials have been issuing warnings against excessive currency volatility as the price approaches the 154.50 to 155.00 zone, a level that has triggered intervention in the past. This acts as a significant ceiling for the pair, making traders hesitant to push prices much higher. Now, let's turn to the daily chart to see how these fundamentals are reflected in the price action. Looking at the bigger picture, we can see a dramatic history over the past year and a half. The pair reached highs above 161 back in mid-2024 before a massive sell-off took it down towards the 141 level in August. Since that low point, we've seen a very strong recovery, bringing us back into this critical 152 to 155 range where we are trading now. The long-term trend has shifted from bearish to a bullish recovery, but now it appears to be hitting a major area of resistance. Let's zoom in on the price action since the beginning of October to get a clearer view of the current battleground. In this focused view, we can clearly see the resistance forming. Notice the candle from November 6th, which posted a high of 154.71 before being aggressively sold off, closing much lower. This rejection aligns perfectly with the news about intervention warnings and weak U.S. jobs data, creating a powerful confluence of technical and fundamental pressure. This 154.50 to 155.00 area is now a confirmed major resistance zone to watch. To the downside, we can see strong support forming around the 151.50 area, which was tested at the end of October and again in early November before bouncing. The price is effectively consolidating within this broader 151.50 to 154.50 range. Now let's switch to a shorter time frame to analyze the more recent action. On the 1-hour chart, the recent volatility is even more apparent. Here is that sharp rejection from above 154.50 on November 6th, followed by a steep drop of nearly 200 pips. Since then, price has been trading in a choppier, more sideways pattern, largely contained between 152.80 on the low end and about 153.60 on the high end. This tight range reflects the market's current indecision as it awaits the next major catalyst. Traders are clearly hesitant to commit to a direction given the conflicting central bank outlooks. The 153.50 level has been acting as a stubborn intraday resistance over the past couple of days. A convincing break above this could signal short-term bullish momentum. Dropping down to the 15-minute chart gives us an even more granular view of the current price action. We can see multiple tests of both the upper and lower boundaries of this recent, tight consolidation range. For day traders, these levels are key. Scalping opportunities may exist between the 152.85 support and the 153.50 resistance. However, trading within such a tight range is risky, as a breakout could happen suddenly on any piece of news. The price action here is very reactive, showing the market is on edge. A break of this range will likely dictate the direction for the next major leg. So, to recap the key levels and provide an outlook, let's return to the daily chart. The critical resistance to watch is the 154.50 to 155.00 zone. A break above this would be very bullish, but is unlikely without a major positive shift for the US dollar, given the high risk of Japanese intervention. Minor resistance sits around 153.50. On the support side, the first level is 152.80, followed by the more significant support area around 152.00 to 151.50. A break below 151.50 would be a very bearish signal, opening the door for a move back towards the 150.00 psychological level. Here are the potential scenarios. A bullish breakout scenario has a moderate likelihood, perhaps 45%. This would be reinforced by stronger than expected U.S. consumer data or hawkish comments from Fed officials that reduce the odds of a December rate cut. A bearish breakdown scenario seems slightly more probable, with a 55% likelihood, given the deteriorating U.S. economic picture. Weak U.S. data would likely push the pair through the 152.80 support level. The most likely outcome in the immediate short term, however, is continued range-bound trading as the market digests the conflicting information. Keep an eye on upcoming Fed speeches and any news regarding the U.S. government shutdown. Ultimately, the yield differential between the US and Japan remains a powerful long-term bullish driver, but near-term economic risks for the US are currently capping the upside. Thank you for watching this analysis on Explain the Charts. Please remember, this content is for informational purposes only and is not financial advice. Always conduct your own thorough research and risk assessment before making any investment decisions.